Housing crash or no housing crash? Rates up or rates down? There's so much noise out there and so many opinions. Today, I'm going to give you some details about what's going on in the market that you can use to help you know, should you buy this year? Should you sell? And stay with me because I've got three really important tips at the end that I'm going to be giving buyers and things that you definitely need to know. I'm Jen Hernandez, lender for lots and lots of years, and we're live today. We're live streaming on all platforms. Please show us the love and give us your questions. I'm here probably for about 30 minutes to answer questions that you might have about rates, market, what's going on. We've got some good graphs today, too. I've done a lot of research for this. The first thing I need you to know is that home affordability is at its lowest. I feel your pain. Check out this graph. Affordability being at its lowest means the least number of people in my 28-year career history can afford homes. Now, this index, these numbers are super small, but this represents lots and lots of years. This is from 1990 to 2023. Now, I've been in the business since 95. So I was kind of hanging out in that green, kind of at a normal number. We've seen lots of ups and downs for sure, but we've never seen affordability this low. Uh, it's inflation, hyperinflation, the lingering gift of COVID. You can call it whatever you want, but it is where it is. We are where we are. Rates are hanging out right now. They haven't really gone up. They haven't really gone down. They've just been kind of hovering for the last few months. So we've seen a little bit of a drop. And hey, Richard, I see you. Thank you so much. Thanks for your question. Are rates gonna drop this year? So I think that they are. I think they're gonna drop a little bit. They're not gonna drop as much as we possibly thought. Last December, I'm just gonna rewind super quick and take you back to December when this great news came out, like, oh, 3 cuts in 2024. Raise your hand if you remember. Well, that hasn't happened. We're now hoping that we can at least get one. That's what people think. Now, my prediction from what I've read is that rates are going to kind of trickle down. I think 2025 and maybe 2026 is going to be the magical year. But let's keep hanging out, and I'm going to give you some data for you data junkies out there. I know I'm one. Let's see what the data says. So interest rates, are in the high 6s, low 7s. It depends what program. It depends your credit score. It depends on so many things. The point is they're not low enough for a lot of people. A lot of people still cannot afford the homes. I can tell you that the home prices are not going backwards. There is no housing crash. I know that there's some of you in different parts of the country that your area might be a little, got semi-crisis. But a lot of places in the US, there's still low inventory. I want to remind you that people are holding on to their homes. Most people, majority of the people in the US have interest rates below 5% and really below 4%. So they're not going anywhere. So we have an inventory problem. So that's why prices keep continuing to go up. The numbers just came out this week of some housing prices. They're continuing to grow. So that's exactly where we are. And we'll have some graphs for you here in a minute on that. So I want to just coach you really quick on so that you can understand why would the interest rates go down? They really only go down in one of two instances. Number one, we're being rescued. There's a crash of some kind. You might have heard or think, or you might have witnessed 2008. That was the most recent mortgage meltdown. And there was this crash of just society, pretty much. And the federal government had to come in and rescue. That's a reason that rates go down. COVID was another one. That was a rescue of something affecting the markets, and we were buying our own debt to spur people to still spend money in that crisis time where it was just so uncertain, right? That's a crash type of a time. Right now, there's no crash going on. There's no crash. So things are moving along and people are still actually spending money. That's actually the problem. So that's number one reason why the rates would go down. The number two reason that rates would go down is that there's a recession. So that's why you keep hearing people talk about in the news, the numbers and inflation and the recession. So when there's a recession, people aren't spending money, people are losing jobs, people are not unemployed. We are not seeing that. So that's another reason why rates are not going down. So I want to flip it for you and give you a few things that why rates would come down. Rates would come down if, again, the economy was suffering, if people aren't spending money and they need to spur the economy. And what controls the interest rates, Richard, thanks for that question. Who controls the mortgage rates? Well, there's an indirect effect. There's not any one Oz behind the curtain that controls the interest rates. So it's a free market. And what influences the rates is the Federal Reserve. The Federal Reserve is not government owned. They are a separate entity that is for profit, and they are the closest counsel to the US government. They were really created to keep the government in check from having too much power. And so they make sure that we're kind of doing what we should do and not going rogue off the reservation is what they do. So they meet many, many times a year. They meet, I think it's eight times a year, and they come out with how the economy is doing. So we have 4 left this year. So when they speak, they talk about the economy, and they control, to answer your question, Richard, they control the overnight federal funds rate, which is the rate at which companies, big, huge companies, borrow money so that you and I, it's a trickle down effect. And when they lower rates to companies, it spurs lots of other good things. It spurs companies to invest more in people and hire more and buy more goods and services and R&D, research and development. So what's happening right now and why companies potentially are failing is because it costs too much to exist. When rates are high, that's a bad thing because they can't afford to expand. They're paying too much for debt. And so the Federal Reserve influences the economy and interest rates on credit cards and cars and all these things with this federal funds rate. So the federal funds rate trickles down and influences what all the rates are doing in all these other industries. So I hope that answers your question, Richard. Thanks for that question. So that's just a little side note. So for rates to drop, we have to be in some type of a recession. Like just think of mortgage rates like bad news. The low mortgage rates do. Like most recently, we had low mortgage rates because of the bad news of COVID. That was bad news. So that's when rates were super low. The other bad news that rates would like is if people were unemployed, losing jobs, not able to find jobs. It would like it if there was some kind of a crisis that we need to be rescued from, because trust me, the US government is going to come in and just add more debt to save us from something. If banks start to collapse, which could happen, we saw a couple banks last year. When interest rates are high like they've been, banks have to borrow money at a higher rate than the people that they're doing deposits for have the money. So they're losing money. And some banks just can't handle that. And so if a big, huge banking crisis comes, that could be a rescue. So things to look at right now. We've got a graph for you on employment. Actually, I need to put my glasses on to read this. So employment is stable. We have a 4% unemployment rate. Now, we don't want anyone to be unemployed, but it's just the fact of life. So 4% is pretty stable. We have that big spike there because I'm guessing that was COVID. There were a lot of people unemployed, but actually the numbers look pretty decent that lots of people are employed. So again, that's not the bad news that we're looking for that would affect mortgage rates. So something that you can watch for in the news when you're like, how am I going to know? I mean, of course, it's going to be on the news. Trust me, when interest rates start to go down, we will all know there's immediate news now. You hear a lot of talk about CPI, which is the core inflation numbers, and they come out every month, and that's an indicator of inflation. And we want that number to be going down. We want less inflation. The reason we're in this boat anyway is because there was a ton of inflation after COVID. I know in real estate, there was a buying frenzy of people buying homes, and houses were going over list price. And you guys have all heard the story because it happened just a couple years ago. And then the Federal Reserve said, hey, we need to choke the economy to keep them from spending money. So they started raising. That's when in January of 2022, the mortgage interest rates like doubled in a month and a half. Like, I've never seen that happen in 28 years. It's just crazy. Well, they were trying to choke the economy to keep people from spending money, and that hasn't happened, which is the problem. Is that people keep spending money. The inflation numbers have come down, but they're not coming down fast enough. So as they're very closely watching the numbers as they come down, even 0.1 or 0.2%, that's going to be a good signal that they can stop and start possibly lowering interest rates. So CPI comes out June 11. So that's going to be an indicator for is the Fed and when is the Fed going to lower that federal overnight funds rate that is going to influence other rates like car, mortgage. It's kind of follow the leader. Okay. Now we only have 4 Fed meetings left this year. The next one is at the end of July, July 30th, and it's almost expected from almost any economist out there that they're not going to do anything unless, I mean, it could be that this July CPI report is going to show something. I mean, if these inflation numbers are super good and they're going down in some miraculous large way, you never know. They could slide a decrease in there. That would be a really good thing. It's expected that possibly the September meeting is probably the better, more likely one. And then there's a meeting in November and a meeting in December. So we've got 4 meetings left, and it's mystery. We don't know what they're going to do. It's going to really depend on these numbers that come out for inflation and spending and unemployment and everything else. So remains to be seen. We could have a surprise. We've had surprises before. So like I said, if these inflation numbers for CPI come in lower than expected, you can expect a little drop in interest rates, maybe a big drop. I don't know, because it could mean that the Fed might do something at the end of July. That would be awesome. So we talked about unemployment. We talked about what has to happen for interest rates to go down. It has to show that people are spending less money. I don't know. I've been hearing about a lot of people on vacation already this summer. I mean, what I've seen is more people are taking home equity loans than ever before. Debt is at an all-time high. I personally have had to take out some debt in order to just, move things around. And kid just went off to college and, typical stuff. The same thing. I mean, credit card debt and home equity debt. There's lots of people that have equity in their homes. And when they're having trouble, they're taking out home equity loans and they're using that money to spend on things. And so we're not seeing consumer spending come down like we should because people have so much equity built up, y'all, from COVID. That was the one gift of COVID is people's homes appreciated more than ever before. So Yeah, thanks for this graph, Jen. My assistant's name is Jen too. Jenny Jen. Americans sitting on tremendous equity. Okay, this is a really cool graph. So, oh my God, like almost 38% of the people own their house free and clear. They must follow Dave Ramsey. That's awesome. They've just living the dream, no mortgage payment. I wish that was me, but it's not. There's about 28% of the people that have more than 50% equity, meaning their mortgage is half of what it's worth. Okay. And then there's about 33% of the people that owe over 50%. So between the free and clear people and people with at least 50% equity, y'all, that's like 60% of the people. That's a lot. 70% of the people. That's a lot of people. So they're either A, taking out home equity loans, or they're selling. Some people have to sell. And that's why you're probably wondering, I do not buy into the naysayers that say that we're going to have this foreclosure crash. I do not buy it. Look at that graph, y'all. If you're one of those people who has 50% equity in your home and you're pending foreclosure and you get in default, you're just going to put your house on the market and you're going to sell it. Delinquency rates are 3.94%. Now, there's always going to be people that are delinquent, always. In history, that a healthy market needs foreclosures. Like, it's normal. This happens in just all of history. There's people that go delinquent. But look at this percentage. Now, the number only goes that I've got goes to like January, but it's still, I don't have numbers sooner than that. But as of January of 2024, we've still got super low delinquency. And so what's happening is these are people that are possibly selling and they're just putting their house on the market so they can get out of the bad situation that they're in. So that's what we're seeing right now. I don't see any indicators of anything happening other than that. I know that there's a lot of pent up demand of people. So I do get asked a lot, like, hey, and we talked about a little bit before, what kind of things would affect the rate? Now, I talked about things that are at home, like in the US, but there's also things globally that we don't know what's coming. In fact, I talked to someone today who's in just today, uh, business person that is in England. And he said, hey, we have our prime minister elections next week. And it is just crazy. It's as crazy here with elections as it's going to be for y'all in November. So, like, other countries go through stuff, y'all, too. So global crises, regime changes, wars, financial crises in other countries. There's other countries who have financial crises as well. Sudden changes in the price of oil, pandemics, all of those unexpected things affect our economy. And I'll tell you why, because Richard asked me a little while ago, hey, who controls the mortgage rates? Well, what I didn't actually finish telling you in the story was the bond market is where the mortgage rates really sit. So when lenders are making their rate sheets for the day, they're looking at the 7 and 10-year treasury bond. The bonds are debt that we sell to ourselves and other countries. We look for investors to buy our debt. So let me tell you what that means. Like, do you know when you go to vote and there's a school bond, like, you vote yes or no on a proposed bond for the school, like, hey, we need to finance and raise money to build a new school or pay teachers more or whatever it is. Do you vote yes or no on this bond to raise money for that? And you say yes or no. Well, it's the same thing in the bond market. There's bonds, which are a safe instrument of like, hey, I'm going to give you, investor, a 4.5% return on the money. Invest $100,000 with me. And the money is much larger than that. But for $100,000, You can buy this 7-year bond where 7 years you're going to get 4.5% return. That sounds like a pretty good gig. So people, investors, people, hedge funds, big insurance companies, big, massive, or even I have bonds in my portfolio with my financial person. People invest in bonds because they're safe and they have a guaranteed return. They don't have to go with the ups and downs of the stock market. So that's why you have that over there. So the mortgage loans, the mortgage rates, when the companies are making their rate sheets every day, they look at the 7 and 10-year bond because average people are in their houses like 7 to 8 years. So that's kind of, they look at those bonds and that's kind of, they mirror, that's how they price, as kind of mirroring what those financial instruments are doing. And so if you want to know what rates are doing, you could just, Google 7-year treasury bond and it almost really clearly matches that. If it's going up, it's going up. And so when we are selling more debt and more people are buying our debt, the interest rates go down. But the interest rates go up when no one's buying our debt. So if there's a global, I'm bringing this home, I promise. If there's a global crisis and if XYZ country, we have some pretty big investors in some countries that don't have to remain nameless because you know who they are. China, they buy a lot of our stuff. Let's say they have some crisis or we're putting tariffs on them and saying we don't like you right now, which happens. Then they're not going to buy our stuff. They're not buying our bonds. So when they're not buying our stuff and we have this big treasury auction, there's several treasury auctions, well, many throughout the year where it's like, hey, we're having this auction, we're having this sale of bonds, and we want companies and people and whoever to buy them. And if no one's buying, then the interest rate goes up to attract more buyers. Like, hey, instead of 4.5%, let's do 4.75 and see if that entices some people to buy. It's all about supply and demand. So I hope that makes sense, about kind of what goes on behind the scenes, and to answer, Richard's question, like, hey, who controls mortgage rates? Well, no one person really controls them, but movements like that influence the rates in very directly. So we want people to buy our debt. We want people to buy our bonds. We want inflation to be low. We kind of want a little bit of a recession so that we can bring interest rates down. So prediction. What do I think is going to happen? Based on the research I've done, and it keeps changing, y'all, every month that these numbers come out, things start to change. But the pretty big consensus is 61. Well, let's see. We got a good rate projections here. May, this is recent. So for the third quarter, which is like the fall, it's estimated that the rates average, everyone has their own little prediction, but it's going to maybe be around 6.8. So that's actually around where it is now, maybe a little lower. And then it'll go slightly down kind of before the end of the year. And then kind of slightly down a little in the first quarter and the second quarter. So I think it's going to be a slow drip. I don't think, and I could be wrong, I've been wrong before, about for there to be a large dip in rates, like something really big would have to happen. Really big. I remember back in 2009, I can't remember what happened. That was after the mortgage meltdown, but something happened. And I remember it was January, and I remember something happened and the rates kind of went down like 1% overnight. And we had so many, all I know is my assistant, my brother and I, who's been with me 21 years, we were so slammed with all of our past clients wanting to refi. That's what I remember. I remember tons of phone calls and tons of stress. So it could happen again, and I hope that for you. If you're one of the people in the last couple years that's had to buy and you're sitting on that high rate, I hope that for you that something, big happens and can lower that rate. And for those of you sitting on the fence, I mean, I feel you. I myself need to refi. I got into an adjustable rate mortgage 8 years ago thinking I had plenty of time to refinance it to a fixed, and I've been saving a lot of money over the 7 years. And I had to take the adjustment because rates went up and blindsided me as well. So I too, talk to me, by the way, before you get an adjustable rate mortgage. I would never do that again. So DM me on the side if you're thinking about an adjustable. They are not necessarily the best way to go. Um, I too want rates to go down so I can refinance my house onto a fixed rate. I am dying for rates to come down. So let's look at what rates do, whether you're going to refi or whether you're going to buy something. I love this graph. In fact, I need to put my glasses on to see it because I'm looking at it on my computer. Um, okay, let's just say that you're getting something that's 7%. I mean, some people are getting 8%, y'all. People with not so great credit are getting 8%. Maybe down payment assistance, you're getting 8. But let's just say I'm going to go all the way to the right to a house of 450,000. And I'm going to go to the middle of the graph to 7%. Let's just say you're at 7% and your payment is $2,994 a month. Now, this is just principal and interest, okay? So I'm on the far right at 450,000. And it goes down to 6. So it goes down 1%. Your payment's going to go down like $300. That's awesome. That's really awesome. So take a picture of this graph, or you can come back and watch it later, but this is really cool. So this is why my prediction is that when rates do come down, I think people are going to come out of the woodwork and we're going to have a buying frenzy again. So 6% is a great number. It sounds fantastic right now where rates are at 7. Hey, Karush. Karush said hi. Thanks for joining us. And okay, thanks for another question. What can I do if I need to buy right now? So if you need to buy right now, you need to look at your budget. I'm going to put a link to a budget in the notes after I post this live. And you can look at your budget and you need to just quit Starbucks and see where you can crank out some money in your budget to afford a payment that's a little bit higher. You might not want to do it right now, but I think you're going to be grateful that you did because your house is going to appreciate when all those people come out of the woodwork to buy when rates really are down. So you're going to get some good appreciation. So if you need to buy now, I think you need to look at your budget if you're feeling like, oh my gosh, these rates and these mortgage payments are just too high. I think you need to look at your budget for the first thing. I think you need to talk to a lender about what it means for a seller to contribute to closing costs. I would look for a home that's maybe been on the market for 60 days. They might be more willing to negotiate. And closing cost credits to help you pay for what's called a 2-1 buy down. So that's a temporary buy down, but it buys your interest rate down 2% the first year. So like, let's say you're at 7, it'll buy it down to 5. And if the second year, it'll go down 1%, which is 6. So it's like you stair step to the 7, but by then rates will probably be down and you'll be refinancing. But I really like that product. I've got a video about it as well on my YouTube channel. It's called a 2-1 buy down, and I'll post that in the notes as well. But seller credits can help pay to buy the rate down, whether it's a temporary buy down or a permanent buy down. There are 2 different types of buy downs, but the bottom line for you means a lower mortgage payment. So I would look at your budget, see if you can cut some things. Do you really need all those movie channels? I don't know. So if you can't buy right now, but you want to buy, what do you want to do? Like I said, get with a lender. Make sure your credit's in check. Make sure what your buying power is and what proper payments are, because online calculators are not always correct. So you want to make sure you're looking at the right information and you want to see if a buy down is right for you, and then work together with a lender and a realtor to make a good offer to a seller to help pay for some closing costs to buy that rate down to make the mortgage payment more affordable. That's what I would do if I want to buy right now and I possibly can't afford that payment. Okay, so I want to thank you for joining me today. Please let me hear your after the fact questions. Keep tuning in. I'm going to be doing live every single week, and I'm here to answer all real facts, no BS, everything mortgage. Over and out for today. And we got one more question. What about an ARM? Can that help you? Okay, we're going to go over adjustable rate mortgages for those of you that are still hanging out. Thank you. Adjustable rate mortgage, in some instances, can have lower interest rates. What I'm seeing right now is that adjustable rate mortgages, it means that it's fixed for a certain period. Like I did a 7-year adjustable where it's only fixed for 7 years. And then after 7 years, it's going to adjust, usually upward to a index plus a margin. So my rate went up 2% last October, and I think it's about to go up another 2% because they only let you go up so much each year. So ARMs can be dangerous. So I definitely would watch my video about ARMs if you're thinking about it to make sure that you know what it is and what it isn't, because I know it's super sexy to say, ooh, I can get this interest rate right now. Well, right now when this rate went up on me, y'all, my payment went up 60%. I'm not going to tell you the amount because you will pass out, but I have a big loan and my payment went up a lot. Okay. Like in the 5 digits. And it has not been fun, but I've made it work, and I think it's about to go up again. So ARMs are not always the best idea. They're good ideas for some people, but talk to me before you get one, and definitely watch my videos about it. Don't be swayed by the sexy rate. I think fixed is usually the way to go. So thanks for joining in, guys and gals and peeps, y'all, and we'll see you next time. Thanks for joining. I'll see you soon.